And I want to make sure that you get as much value from our time together as possible. And the best way I know how to do that is to kind of describe a little bit of the atmospherics that are in play with your activity in the markets, and knowing what the current structure of the markets is, and the tools that others are using, and the technology that's being brought to bear has to be top of mind for how you participate in the market. Because if you're not aware of the latest technology, if you're not aware of where certain trends are going, you can be rest assured that others are, and they're eking out ever more profits from the market. And you want to be on the winning side of those decisions. If, as one, if you're lucky, the other, if we could all imagine the possibility of actually making our own, informed decisions, where we control a bit more of not only our lives, not only of our actions in the market, but through our own decisions rather than following anyone else. And I think that's very empowering. So the markets can sustain a livelihood, and they can reward, but increasingly it requires, as a core competency, the ability to manage huge amounts of data. So here I am, I'm going to show my screen. Everyone should be able to see that now. And what I promised to do in our time together is, here we go, is to walk you through a little bit of the impact that what our version of machine learning, artificial intelligence does in the market, as just a case study of this technology that's impacting not only other industries, but certainly the financial markets. And then I can, even if we have time, show you a little bit of the tool in action and how it's performing in the markets today, and certainly take some of your questions. So I think that will take us all through the time that we have allotted, which Renee will take us to, is that 2 o'clock, is that correct?
Yes, that's correct.
Okay, great. So let's bring the goods, and let's talk a little bit about this shift that's happening, where we all have to recognize that we're living in a human and Holly market. And Holly, the reason why I use that term is, Holly is the name of the system that is comprised of a machine learning artificial intelligence. And I'll define a little bit more of what that is in a moment. And to premise this for a bit, Trade Ideas is a software provider. We are not a broker dealership. All of the, your results with this software and this technology may vary, and we don't purport to guarantee results, from the use of this tool. It's simply because we do rely, and we do think currently, that the best combination isn't just entirely AI taking over, or entirely woman or man, in decision making, but the combination of woman and machine, man and machine, make for the best combination. And we'll show you how that blend works. In fact, that blend is part of what Paul Tudor Jones, a famous hedge fund and portfolio manager, has said, which is that no man is better than a machine, and yet no machine is better than a man with a machine. And that I believe is an axiom that will continually prove to be true for the near long-term future, we can say it that way. And especially over this kind of timeline that I'm showing right now, that marks where we've been and where we are today. And I put this on the same timeline, the artificial intelligence, the use of man and machine, and even robo-advisement, these trends that we're facing today on this timeline, because it's along with these other significant changes in the market, because that's what we're experiencing today, change in the market. And that yields opportunities for those who are attuned to it, and that can yield misery for those who don't see it. Just like we had the early technicals in the 70s and 80s, the creation of technical analysis, if you will, we had the rise of the SOES bandits, the original direct market access into the trading floor electronically that was provided. SOES stands for Single Order Execution System. My partner was one of these original SOES bandits, Dan Merkin, in the 90s, and sat along some of the early software engineers that wound up building CyberTrader, which was later sold to Charles Schwab out of Austin, Texas. And then we hit the 2000s when we really changed the markets. Most people don't even remember what it was like to trade in fractions. I do, but decimalization made things a bit easier. And then we hit high frequency trading, and then we hit certain trends like big data. And now from that, we kind of arrive and evolve at what AI and robo-advisement and their impacts are having on the market. So I'll just take a couple of slides to kind of further set the table about what does this current era mean? How is it relevant, and how are you feeling this as an investor and trader? Which, by the way, I'm assuming most of the audience is. I don't know if there are professionals here, but we can certainly, in your questions, answer what we do for institutions and professionals. But I am going to keep my remarks focused more on those who I'm assuming in the audience are retail, individual investors and traders. So I'll kind of briefly go through these next couple of slides. This is just a fund flow chart that shows where the active fund flows and passive fund flows are doing over a period of time. That really is, this chart is a little bit old right now, but this was from 2016. You could already see cumulative flows of money going into passive and out of active, to the tune of a decrease of $109 billion year to date and an increase of $35 billion. This was before 2017. So in 2017 was referred to as the year of the hedge fund redemption year, where we had half a dozen to a dozen hedge funds closing because of withdrawals. And that trend has certainly continued, and I've got some updated charts here. This is a prediction as to when active managed funds and the assets in them are still predominantly larger than the assets under management in passive funds. And by passive, I mean robo-advisement, set it and forget it, kind of planned, indexed to time horizon funds. And that switchover, though, is about to occur in 2023. Some say even earlier now in 2022, where more assets under management will be under passive investment vehicles than in active. And there's nothing wrong with that. And I certainly don't mean to imply that there's going to be the death of active management funds and everything goes to zero and all of it goes into a passive index. But it does mark a kind of movement to what passive investing is, which is a very powerful heuristic that says, I would rather be average with the market, be average, which is the market, than to underperform it. And when I see active managed funds underperforming the market, that's worse than that certainly is worse than matching what the market is, and it's so rare now for active managers to consistently perform above the market indice. And there are structural reasons why for that, by the way. When you have to have and match a particular index, like the NASDAQ 100 or even the S&P 500, you have those stocks weighted to represent that index. And so therefore, certainly the NASDAQ 100, you have an outsized weight applied to Apple. If a fund manager had that same weighting for Apple in their fund, he wouldn't last long. He or she would not last long in that position because it's just too much exposure to one stock. But an index, that's what an index has to do. So it becomes very hard sometimes for structural reasons to outperform certain indices. And again, this flow into passive management funds says, in a way, I'd like to set it and forget it, and I'd like to at least match what the market's going to do. And when you frame it this way, it's important to understand that that's an important part of a portfolio allocation, as much as putting it into international value or small cap growth or real estate or every other part of your portfolio. Passive will play a role. But you have to know that there's, by definition, there's no alpha in passive investment, because passive seeks to, match the index, no more, no less, and do so with the littlest fees possible. So active management will still be around, and it will still be an important part of a portfolio allocation. And our purpose here today is to kind of show you some of the tools that are being used and that will be used going forward in active management. Okay, I'll skip over this slide. This just talks about, again, mutual fund outflows and from ETFs. The most occurred in, so this is an updated slide. This is from June 2018. The outflows in that month were the most seen since August of 2015. So total of 20 billion out, a little bit out of passive, but most of it out of active, just out of the market. This slide again talks more about artificial intelligence, not just in financial services, but really across all industries. And in a survey of about I think 1,000 or 2 companies by the National Business Research Institute this year, over 60% have initiated projects and adopting, again, loosely defined and defined differently among each of these companies and industries as artificial intelligence. But there is capital being spent in this area in order to improve production, improve analytics, improve the insight with which industries and companies are creating oceans of data. We have the Internet of Things that can read our temperature, read our body, read our biosignals, inform our clothing, how to react. We have devices that now connect to our homes and that turn on and automate, and that same technology applied to production is all being automated, and it all produce a huge increase in data. And that era of big data was only able to be analyzed at a fraction of what was being produced. But fast forward, at the beginning of this decade, and then just in the last 4 or 5 years, as our computing power has continually increased and it's gotten more scalable to use services like AWS and Azure and so forth, you've got the capacity to process big data in such a way that you can get more analysis and analytics out of it. So that's what this slide kind of shows, is that more are using, say that they've implemented AI and the like. And again, the slide more kind of a viewpoint of how is the task of pulling out from big data analytics and decision making and analysis, and that's being driven across with these percentages of tech innovation and strategies around AI across industries. So we'll bring this back to the financial markets here with this slide. When it's part of a publication from the UK in July of this year, surveyed a collection of hedge funds using AI and machine learning, and they discovered one particular interesting insight that came out of it. Using artificial intelligence and using machine learning, from where, as I refer back to the timeline, we were high frequency trading firms were and still are a structural part of the markets these days. And the use and evolution of AI into financial services, for many, there was the thought that this was, of course, being used to execute better. But it turns out only a third of firms, and hedge funds rather, are using AI for trade execution. 2/3 of hedge funds are using it to actually generate trade ideas. And I should say it's 67%, 2/3 of it using to generate trade ideas. Of this 56% who replied that machine learning, artificial intelligence is informing their decisions, but it's informing their decisions about what to trade, not necessarily how to trade and execute. Okay. final kind of table setting slide, and we'll kind of go into a little bit more of how trade ideas as an example of all this, applies these terms and produces our value proposition. But we keep an eye on some major competitors, some that are far larger than us, like BlackRock and good old Larry Fink, who's the CEO of the firm, who suffered some pretty significant losses as I think at the beginning of 2018. It's upwards of $500 million in the first 2 months of the year. They have the capital, they have the PhDs, and they have the infrastructure to suffer a loss like that and without breaking a sweat. But it does show that, in fact, that those kinds of losses, applying machine learning AI to make these decisions, it's not an easy task. And that'll come into more relief as we kind of show you some of the performance-based results that Trade Ideas has had on its portfolio using the technology. But Larry's point here is that the page has turned and we are in a new era, and principally because if you're an active manager, you're competing with everybody who has access to information. Access is no longer the source of the advantage. That was the case in previous years. Whether you had a seat at the exchange or whether you had access to CEOs, before and above others, access is no longer in the equation because information is available everywhere. It's been democratized and it's instantly available to everyone. What has to change are the tools once you get how you use this information, and therefore the reliance on core competencies in big data. Querying it, bringing analysis out of it, using models and factors and quants are the new tools that must be used in order to continually find that advantage. I actually spoke with the CEO of Interactive Brokers, Tom Pettifree, and one of his first questions to me, I was kind of like we were in a green room and it was the leading up to, I was the warm-up act before his keynote. And in the 20 minutes or so before I went on, he was like, "Trade Ideas, tell me about you." And before I could even start an elevator pitch, he's like, "Just tell me how you're front running the market." I'm like, "What?" Because what he was using as the word front runner is this element here in this quote from Larry Fink, which is what advantage are you bringing to the market? If it's not access, what is it? And that's when I had to kind of step back, kind of understand what he was asking, and then respond with, our advantage is this ability to process big data and to present it to our clients in as elegant a way, elegant being the opposite of complex, I guess, but still sophisticated way as possible. Okay. So let's bring this back and make this a little bit more relevant. How does this pertain to the task at hand, which is we're trying to engage in the market and find alpha? Well, the problem we're solving and where our value proposition exists is in this kind of imagery between, swimming in an avalanche of data, but not in terms of information, kind of walking the desert and looking for that oasis as to how, what action do I take? What's the information that that as a result of all this data that I need? And so we talked about passive and index investing. That makes it hard to find returns in large cap stocks because of how that's all arbitraged by so many overlapping. I mean, there are more funds out there than there are stocks in the market, publicly traded stocks in the U.S. market. The sense of for your advisors who who you use and who also we encourage to look at trade ideas and are seeking this kind of information and who are trading on behalf of their clients. There's a lot of advisory fee pressures for those to provide service and not have their clients throw up their hands and say, "You're not cutting it anymore, and I'm going to put all this money into a Vanguard index fund and not pay any fees." The need to differentiate by those firms, the lack of performance-based research, and then still we have siloed data sets like technical. So people make decisions these days about Well, let's look at it from a technical basis. And then let's look at the same opportunity on a fundamental basis and layer that in. And then let's look at something else that we may find, which involves either social media or there's data sets out there that even show you the proximity of phones to certain retailers in order to determine, hey, there's traffic with the old cars in the parking lot of the mall used to be models. And they're all siloed. They're all separately, it's almost a separate analysis. And part of the big data competency is how do you blend all that data together and then pull out of the patterns across all these data sets. So what Trade Ideas brings in terms of its machine learning artificial intelligence is the ability to assess and adapt. And we do this, you'll see this in action in a moment, but the system learns in real time what conditions is it operating under for everything that it's prepared overnight and everything that it puts in front of our clients in the morning. How does the result of that overnight research, does that perform in the markets each day in real time? And so the system will generally have two flags that it raises, a risk on and risk off, to help show the real time where the momentum is, in the market. I don't mean momentum in the sense of like trend, but what are the conditions? It's like looking at a weather map and being able to understand quickly whether conditions are right or whether conditions are not right. They're not favorable. The risk on flag says the market is in fact trending. The trades and the trading plan in effect should continue, and maybe even longer than some of the parameters that have been initially set. So that could be profit targets, that could be hold time targets. You can carry them for longer to the end of the day and even beyond. And it leverages, again, momentum that it sees in the market. Whereas risk off is quite the opposite. It means take risk off of the table. Don't let profits turn into losses just because a hold time parameter or a profit target isn't met yet. If there's a profit, take it off the table. Because the markets are choppy, because what it sees in what it's looking at is not tenable or sustainable. And it's weaving between these two kinds of conditions that help in real time the AI to serve as a sort of virtual analyst, sitting there and guiding and providing guide rails to decisions. Because it's way too easy, as we know, to get an idea from someplace, from CNBC, from the Wall Street Journal, from a neighbor, from a dentist, anywhere. It's easy to get in. It's not so easy. There's often nothing discussed about how to get out. But this virtual analyst, if you will, is constantly kind of showing the degree in which we're in a risk on and risk off environment, and how and when, if that changes. And I'll say this is an important point that is a source of optimism that I have about the business and about what we do. And we do change lives, and how you can build a life, being sustained by the markets. The following is kind of where I draw all of this optimism, and it's simple. Well, in any investment and trading decision in the market, there are only four outcomes. And we are trying to get into 3 of those 4. You can guess what they are. There's a big loss, a big win, small loss, and that's all. A big win, small win, big loss, small loss. All we're trying to do, we'll take a small loss any day. We'll obviously take a small win. And big wins, yes, may I have another. All we're trying to avoid is the big loss. So if you're parachuting in, or if you're trying to determine an outcome, and 3 of those 4 scenarios are safe and only one's wrong, that you don't want to land in, that's what our system tries to do. It tries to avoid large losses. And that means you've got a 3 out of 4 chance of being satisfied with the decision, if properly informed. And that to me it brings great comfort. And it's something we're able to achieve consistently, which is also another source of, it'd be great to think about this, but not be able to perform or execute that. All right. This is what we mean by executing on and helping people land in three out of four squares. What you're looking at is the performance just up to June of this year, Q1 and Q2, the long short portfolio analysis of all the ideas, all the ideas taken by Holly and the system. So what we run is a portfolio. We have to create some kind of benchmark in order to show the performance. And the way we construct this portfolio is not necessarily the way that you might, depending on your risk parameters as well. But for the sake of at least informing what kind of results that we get, we make clear that this is $1 million portfolio that for each idea submitted by Holly each day takes an $80,000 position. So a maximum of 12 positions before all the capital is used. That that rarely happens. It's more often the case where positions are left and then capital's freed up and then more is applied, because we often will have, sometimes, not all the time, but more than 12 trades in a day. And that kind of explains that. But $80,000 per position. And then for our portfolio analysis, all of the trades, whether it's risk on or risk off, at the maximum, all the trades are held until the end of the day. So the end of the day, the system goes to cash. And the reason why we do that, it's important to note, is because that may sound like, well, this is an intraday trading system. It's not. Again, because it's not auto trading for our clients, we provide the ideas, we provide the guidelines for the optimized trading plan, provides the guidelines for being in that trade, as well as the real-time assessment of a risk on and risk off. All those guidelines are meant to be the first indicator of where you would, for instance, if the profit target is reached in a risk on environment, it says it's not time to take profits. On the contrary, you could take half the position. You could certainly double it if you think that the risk on and the opportunity and how it all looks on the chart and your analysis would lead you to believe to maybe perhaps double the position. You can. So how all of this gets interpreted is also the basis for all the variation. If everyone were auto trading these ideas, we'd quickly extinguish the value. We'd arbitrage everything out. But by providing and only providing the analytics, we allow a lot of, not everyone can follow or should follow all the instructions or will, because of their ego, because of their own training, because of what they bring to the market. We are focused though on providing as clear information to help with the guardrails of making a decision and helping you do so consistently. So let me go back to why, again, we go to cash at the end of the day. The reason is because we never wanted any of this 54% to be the result of, say, holding Home Depot for 3, 4 months, 6 months. Home Depot has been a great stock. If you've held it for a year, you've done fantastic. What we wanted to show was that all of this return, this 54%, is a result of each day's performance in the market, either adding to or subtracting from a cumulative performance. So that's just for our purposes, because if I could show you this 54% and maybe half of it might be attributed to being in the Home Depot position for 3 months, and it would dampen what the purpose is of what we're trying to do, which is promote good performance-based trade ideas. So instead we say it all goes to cash at the end of the day, we restart. Our clients don't necessarily follow that pattern. And in fact, we also sell to institutions the record of what trades were made during the day, because they realize that if this AI was able to come up with the idea, do we think that it would have more value even after this day is over? The answer is yes. And we've actually have third-party research that's looked into the performance of the ideas and what they call drift, how much more energy or how much more return do these ideas have. And the analysis, as much as 300 basis points up to lasting up to even 20 days after the idea is generated. So This is a risk-off version. If we were following all the rules, even in a risk-on environment, if we were following all the rules as they related to risk-off, the most conservative way of looking at the performance of the AI, this is still a 17% return, well above for Q1 and Q2, well above what the SPY, the Dow Jones Industrial Average, the NASDAQ Composite, or the Russell 2000. So this is looking at it in the most consistently conservative way. What I don't show you is the combination of risk on and risk off. That's almost an hypothetical, because you'd have to get every trade right. Like, okay, this is a risk off trade, or this is a risk on trade. And it's not even worth showing you that. It's a ridiculous number of return, but it's not even practical. But just picking one, just to show what the results are, this is what risk off did. This is a similar number as before. Instead of 54, it's actually 56%, but this is all of 2017. So all of 2017 yielded a 56% return in a risk-on mode for the portfolio that we ran that year. This is what I was talking about before. This slide refers to the cumulative returns of the trading ideas after the day of the trade idea. So on the horizontal axis is time, days, and on the vertical axis is the number of the cumulative return. And interestingly enough, what it actually shows, this may be hard to read or hard to see the differentiation of color, but the larger trend line there is returns on the short side. So short ideas actually had a longer drift of returns after the day of the trade idea than long strategies or long algorithms, almost double. And that was interesting research that came out of this third-party firm called Extract Alpha that did a diagnostic, or an analysis rather, of our of the year's worth of AI trading that we've been doing. And I should note that the first day of the AI, machine learning AI, as we call it, that was launched was the first trading day of 2016. So this has only been since 2016, and now we're into our third year in 2018 here, closing 2018. Okay, here is a kind of brief snapshot before I'll show you what how it all looks live. But this is an important slide where we can just kind of freeze a moment in time and kind of pull apart what's happening and what you're seeing. So I'll start with the upper right-hand corner and move to the left in a moment. But in that upper right-hand corner, you have essentially what the Holly, the system, is doing over the course of the day. And on this particular day, let's start on the far left. What you see is a graphical representation of the P&L. So at the time that this was taken, which was 12 o'clock Eastern time, actually, this is a somewhat older slide, or older snapshot, but this was November of last year, so 12/10. On this day, the P&L was doing very well. It was up 2 points, 251 basis points, so $2.51 rather, which is, if you were trading 1,000 share lots, you'd be up 2,500. If you were sharing 100 share lots, you'd be up 250. In this moment, at this time, you can clearly see that the risk on flag, or the risk on mode, is on. It says risk on, and it's on. The risk off is also profitable, but less so. So the trend was in favor of more of the results of the trading in the current market that these ideas were finding themselves in. The conclusion was a risk on day, or a risk on moment. And all that was fueled by ideas coming from eight algorithms here, of which 6 were long algorithms and 2 were short. And you can see the names of these algorithms and these strategies that the system selects out of a larger pool of out of a larger inventory of algorithms that we maintain. What the system does is it goes through and it will test based on the last day's trading and even farther back all of the parameters of each algorithm, and it will change values in order to see if the more current day's worth of analysis makes this better if the values of each indicator within each strategy are changed. But it will also even add new indicators from our inventory of alerts that we have. So it will substitute, it will add, and it will change the values of existing factors within the algorithm, always in the search of a more profitable result. It will even then change the trading plan. Suppose after changing the algorithm and the indicators and the values inside of it, it turns out that the trading plan applied to this algorithm performs best in the afternoon than in the morning. So it won't even consider the algorithm until the afternoon. Suppose that it's actually found this algorithm performs better as a short algorithm looking at large cap stocks. So it will remove on a market cap basis the lower, smaller and mid-size cap companies from its analysis. And so it will take the trading plan and it will take the actual algorithm itself and test those millions and millions of times overnight, and then arrive from an inventory of about 60 or so of these strategies. It arrives at about 8, sometimes 7 algorithms, long and short, that it's ready to give to our clients. And so these columns kind of show some more information about what the win percentage was before, leading up to today, what the win percentage is in the actual today's trading, what the risk on and risk off profits are, and then how many trades have come out of these algorithms. So you can see that the bottom 3 don't have any trades as of the morning session coming through those algorithms. And then the rest of this looks as it looks. Actually, let me step over. Let me go to the left here. So this chart on the left is what the S&P did during the same day through the morning up until 12 p.m. And the point of this slide in showing the S&P is that the SPY was in a very tight range of just 60 cents from 9:30 to 12 p.m. Eastern. But during that same time, where in this range, the overall market was in a very tight range, the ideas produced by Holly, as we saw at the very beginning here, the P&L, was over $2.50 of alpha captured by the alpha, so by the AI. So over, almost over 4 times what the range in the S&P was, pulling out profits, pulling out alpha, long and short, from the market. And the results of those trades from that day, what you see just below that chart on the left here. So these are, now you can actually see the actual symbols that day that were traded from the algorithm. The breakdown of the, and you can also see the last column here, what the exit reason was for these trades. Sometimes the time in trade was, arrived at its stop. Other times in a risk off mode, it took a profit, said profit save that profit. And other times it also in a risk off mode decided to go, and reduce its risk. In a risk on mode, it would still be in these trades, and that's where you kind of, that's the difference there. Okay. I've got just a couple, this is going by a little faster than I thought, but this is a very high level view of just what the process of how we define. So definitions, again, machine learning is this ability of brute force computation, processing power, to take a huge data set and run millions and millions of basically if-then kind of statements. If this happens and it's better, then keep it. If this happens and the outcome is worse, then drop it or change it or do something else. And that kind of learning of the system is what helps develop the algorithms. And then there's a whole other component that looks at the real-time assessment of the market and how the ideas are performing. But stepping back, the inputs, as we talked about before, how do we break down the data silos? So we take in technicals, fundamentals, and non-structured data like social media and earnings, and it all flows into a historical database where we catalog everything, we document, we analyze, we even create studies and we create our own data, derived data from the data we're receiving. So we create our own data points by manipulating some of the data that comes in. And that gets used and studied and looked at. And that goes to create what are the base strategies, this inventory of 60 or so algorithms that then what we call the quantitative combine, it's like going on and seeing the NFL players, run certain do certain physical feats under time constraints just to assess their physical abilities, the scouting camp. That combine is what we do quantitatively with all of these algorithms as they prove themselves and say, am I waxing in this market or am I waning? Am I growing in strength or am I fading? And that's what that combine produces. It produces the daily regime of algorithms. And from there, then we were able to add filters like custom preferences. Even after the ideas are produced, some of our clients don't want to see certain types of market cap or certain types of ideas that are below their threshold for, by their governance and trading below certain market cap. So we eliminate the view of that. But we also add our risk assessment, as I mentioned, the risk on and risk off. And we also look at actual custom portfolios. So we don't necessarily use the algorithms to produce the ideas. We will look at the custom portfolios especially for professionals. We'll look at their clients' holdings, and then we will run it through the AI to say, this is where, if I were trading this is where this is where I would grow the position, and this is where I would exit. And all of that is meant to lead to this alpha capture. Okay, wrapping up. Love this quote from one of our mentors, Adam Goldberg, that talks about, look, AI is no longer a point of differentiation. You are not going to, you lose if you're not using it, but you won't necessarily win if you do. It just means you gotta have it just to play the game. And I would challenge then everyone to kind of think about take a look at the range of service providers you're using, everything from your broker, everything from the actual services they provide, the other services that you use to augment what your broker's doing in terms of research, and assess, does any of this research have a performance record behind it? Does any of it have an updated way that I can assess how good these ideas are on demand? And then secondly, are those ideas being powered by something more than a notepad or an Excel spreadsheet, or how is this sausage being made? And those would be the questions to kind of turn around and ask your kind of existing providers. What are they able to produce performance results? Are they able to show you how they're coming up with the way that they come up with these ideas, and what's their plan for using some of these new techniques of big data and quant modeling and the like, and machine learning, artificial intelligence. To close, these are some of the partners with which we do work, and are very proud to have worked and continue to work for. And we've been in business since 2003, but only in the last 3 years has the AI really propelled the success of the firm. And so that's why I love talking about it, and that's why I'm thrilled to be able to spend the time with you in describing what it is we do. I'll pause the screen here. Feel free, by the way, to visit trade-ideas.com, and feel free to visit the website where you can receive a trade of the week. If you give us your email, we'll give you a trade of the week that is picked by our data scientists as a result of what the AI kind of chooses it, makes a list, and then we pick one so that we're not so that we're varied enough that if we've done 6 biotechs in a row, we'll pick an energy company or vice versa. But the website will give you the ability to receive a trade of the week for free, and that's waiting for you there at trade-ideas.com. I'm going to pause the screen for a moment, and I'll take questions while that's happening. If Renee, if you can, rather than read them myself, if you can read them for me, we can take a few questions, and I will try to pull up the application here so you can see it in real time. So Renee, if you can, are there any questions? Please don't be shy.
There was a question from Dee Dee. This says, please go back one screen. It looks like that was just sent, so it might be the last screen you had up.
Let's see. that's it's just got my contact information, which is david@trade-ideas.com. You can do David or info@trade-ideas.com. If that's the slide in question, that's what that refers to. Let's see. Any other questions?
That is all I see right now, but I will let you know if any more come in.
Okay. I'm pulling up doing my best here to pull up the application. We have two versions of it. We have many versions of our data. We have two versions that are a graphical interpretation of the data, a GUI interface, if you will. We have one that's downloadable, and we have another that is available on the web. And they each have slightly different capabilities. The downloadable version is a bit more advanced. We are rapidly closing that gap with what we're trying to do on the web. So I will try to show this to you in just a moment. Are there any other questions?
Nope, that's it.
Okay. Well, I'm having a little bit more difficulty than I thought pulling this up. Here we go. Okay, here we go. So I will show my screen. Everyone see that's taking a little bit because of the sharing of the web conference is slowing a little bit down. Here we go. This is our web-based feature. And just to kind of, again, describe what it is I'm showing you, is this is my own particular layout. It has three charts at the top, 5-minute, a daily, and then what the S&P is doing in kind of contrasting color. And then I have a series of alert windows. None of this is the AI quite yet. What this is our other views of the market, principally the layouts that I designed for my own use when I'm wanting to watch certain other items, which in this case, a blockchain volume watcher, and this one being a kind of also a blockchain SMA tracker. So if I look at see if I click on the AI channel, we have a series of channels that are different motifs, if you will, different themes on the market. And by clicking on, I get a unique layout that we've designed. And so this is again another this is the web version of the tool. We can see that here we go. The AI is in a risk on mode. Risk on is a $1.05. It's had a rough morning to get there, but this is where it is right now. And then if I click on risk off, it'll show me risk off. Again, I apologize for how slow my connection has become, but there it is. If everyone can still hear me. Yeah, I'll go back to risk off or risk on. And then we'll see the list of here are the strategies. Here are the algorithms that were selected today, whether they're long or short, and how they performed. This will all, again, populate in just a moment here. There we go. Okay, so I can rank all of this by how it's performed leading up to today. 75% win rate to as low as 59. Here are the trades today. So on support, the algorithm called on support, which is a long strategy, has traded the most at 4 times today. However, it's only won 25% of the time out of those 4. So only one of those 4 trades was profitable, and it's been a contributor toward the risk off as it's left the position. But if we had stayed in it, which is what risk on is doing, it actually has turned into a profit. Right? If I click on any symbol, the results down here are the actual trades themselves. There are no trades currently open. All the trades are closed. And if I click on the symbol, I can see those charts. Let's look at a winning trade. A lot of the winning trades, by the way, have been short today. So here's KBH. Again, on the left-hand side is the daily chart. On the right is the 15-minute chart. Am I missing any questions? I haven't been looking. So quick question I will answer here. This is a system that looks only at equities and option volume data, and ETF and indices. It does not look at futures. It's a good question. What is the win rate using AI versus not? Well, both win rates I was discussing. The win rate leading up to today, that each of the algorithms has how it's performed, is really the back test of the algorithm. Is one win rate, and then the second win rate is how has it performed today in the market. So if you don't use the AI, if you don't use the AI and you use the signal, meaning I'm assuming the question is if you don't use the AI's trading plan parameters, how would you perform? Well, and that's part of the beauty. That's where your mileage would vary. We only document and what it is to use the AI in these 2 modes, in a risk on or a risk off mode. So I hope that answers your question. That's a good one. That's a good question. What was that part about the 20 days ago? Again, I missed it. Well, 20 days just referred to this one slide I had that where a third party did an analysis of all of the cumulative, the totality of all the trades, and looked at the average of how each trade, the day that it was published, and then 20 days later. And what was the average return? Did it go down? Did it go up? And over the average, these ideas had as much as the long ideas had as much as 150 basis points, and the short ideas had even more, almost 300 basis points. Up to 20 days after the trade idea was published. Okay. So good question, and we can end on this as well. Renee, just tell me kind of what time on which I have left, and I'm happy to put an end to it. But the service, we are a SaaS model. We are a subscription-based model. So most of the other firms that are using AI do so behind the wall of an investor and a fund. We have a mission to make better decisions for our clients, no matter who they are, but to do so on the basis of getting access to this technology, right? What we talked about all throughout the hour here is that the access is what's important, and right now the service is offered as a subscription. So if you go to trade-ideas.com, you can visit our pricing page and see not just what our regular pricing is, but what specials that we have that we run. But on average, with the AI, it's an investment, and it's I think as much as $2,200, I think, for the year, which comes out to dollars a day, as we like to say, a Starbucks latte a day. And so the data that you're looking at here is a subscription, is based on the subscription, access to the AI and access to the other channels, which are significant. We have a great variety of other ways of looking at the market that use the blend of technicals, fundamentals, and non-structured data to create that lookout. And these are often used as well. For instance, a common workflow is to come in the morning and check out the pre-market, channel, And then when the markets start, many go to the AI, and others will look at find their own analysis and their own conclusions by either looking at these other layouts, or I have not even discussed the ways that you can actually, outside of the AI channel, you are able to go into these strategies and design and configure your own. So this whole conversation, and I don't mean to turn this into a product demonstration, but this conversation was about AI, but the tool itself allows you to go into and create your own algorithms, back test them as well, and modify the ones that you see. And again, this is a little slow because of my bandwidth issue in doing this web conference and running the software. But you can create your own, you can choose among our filters, again, pre-existing strategies, alerts, and the exchanges. You can create your own view and test your own views of the market. All right. More questions. Is there anything like the AI tool in the market today? You'll have to judge that. I know that there are, we used to have more competitors, we have less now. I mentioned BlackRock as other kinds of companies who are using this technology, but as I said, they're behind a fund wall. They're behind, you have to be an investor or, in these funds to take advantage of the technology. I would say this: be careful. Yet another question: if you come across vendors who are using the term artificial intelligence, as a marketing on their website, just to make sure you see the plumbing and you see where is the determination outside of the human that shows the amount of this competency, this core competency of managing big data and pulling out insights in real time. Look and ask for those kinds of questions. And the question is, why is it not used in Forex? Well, the future of trade ideas is the addition of other asset classes, and that will take us to futures eventually, and will also take us into cryptocurrencies. It also may take us into Forex, which follows, whichever you put first, cryptocurrencies or Forex and cryptocurrencies. But there are plans to do that, we just don't have that at this time.